Hi, my name is Derek North. I'm an enrolled agent, Premier Account Executive, and the Continuing Education Director for Federal Direct Tax Services and PreparerTraining.com. And today we are going to be going through the presentation for our TCJA, or our Tax Cuts and Jobs Act presentation series. This one is called Compared and Contrasted. The biggest concern for today is going to be comparing pre and post act changes to individual returns, and we're going to be going through the lens of a specific return scenario comparison. Long story short, we got a return 1 year, going to take a similar situation in a post-act scenario environment and try and compare and contrast what's going on differently using mostly the same information, minus various increases due to inflation, etc. I'm going to talk about areas of concern in particular, comparing tax calculation amounts, differences in refunds, talking about what is present in 1 year that might not be present in another, or likewise things that were introduced. And we're going to talk about suggestions for different types of strategies and avenues of concern for the upcoming tax year 2018 season to begin in January of calendar year 2019. This will be a 1-hour course under the tax law updates category to be reported to the IRS and relevant state authorities upon completion. If you are watching this right now, you will take a quiz upon completion of this presentation in order to demonstrate your retention and understanding of the material, which will then be used to validate that your credits are worthy to be reported to the IRS and relevant state taxing authorities from our IT department once we have the rubric for you. The three scenarios that we are going to be going through are going to involve three separate filers. The first is going to be Jake, who is just going to be a single filer of modest income. We're going to do a comparison between 2017 and 2018 figures. Next, we're going to have Ron and Tammy. They are family filers with a large family, and we're going to have a couple of different twists thrown into the mix in order to generate some different results from year to year, because there are some pretty significant changes in particular in regards to dependents. And then last, we're going to have Devar, who's going to be a big city, a high roller, lots of itemization, high income, going to kind of see what happens in regards to that itemization. The Schedule A is one of the most significantly impacted areas for individual returns for the 2018 season onward. And as a side note, for any portion of this presentation where 2018 values are released, we're going to be operating under the assumption of these scenarios being on or after December 31st, 2018, in order to use our existing knowledge of the changes from the TCJA in calculating the impact. Now, that does mean that any law changes after this presentation is being recorded in June of 2018 will result in either corrections to the material through video format or an errata document being released in order to clarify any differences in interpretation. As well, we will also likely get draft versions of the software operational sometime towards the end of November, early December, which will allow us to see some of these things in action. The TCJA is one of the biggest and most significant changes to the tax law in over 3 decades, which means that there's going to be a lot of work on the legislative and the enforcement side of things in order to clarify situations and clarify interpretations of that law. It's very likely that legal challenges in particular will persist for several years or even several decades in some cases, depending upon how the legislative wind rolls. And with that, we're going to go ahead and move on into some of our first slides. With the first of our scenarios, we have Jake, EMAC, and he's a mid-level regional manager for a local business. And for 2017, his tax situation was the following. Got a single filer, no dependents, 57 years old. So not old enough to have the age-based increase to standard deduction amounts and deductibility off his taxable income, no blindness or anything else, no estranged spouse, no kids. Form W-2 wages totaling $48,357. Federal withholding was $5,694. The state and local income taxes withheld were $1,615, and $947. He also had elective deferrals of $1,934 to his 401k and had $2,704 in premiums annually paid through work for health insurance, which are reflected in box 12 of his W-2 with a code D and code DD respectively. In addition, he also had mortgage interest of $1,530 and a real estate tax paid amount of $1,734. And the value of the original loan was a fairly modest $48,575 when he started it almost 2 decades prior to the start of this particular tax year. Now, Jake also had some expenses connected to his work. During the year, he had to take a flight to Austin, Texas that cost him $376. He had hotel and travel expenses in Austin for $568, and he was deducting the GSA per diem rate for meals and incidental expenses for $148. In addition, he also drove 2,765 miles on the clock during the year for a total of 1,479 in pre-reimbursement mileage deductions. Now, from his boss, he received a reimbursement of $1,126 for his mileage and meals and incidental expenses costs, of which $75 was paid for the meal costs, and the rest of the amounts were paid for mileage. The total, once it was plugged into the 2106 in order to get that value for the Schedule A, comes to $1,409. And he also has a number of other expenses that allow him to itemize. He had the combined total of $2,562 in local income, state and local income taxes paid, $385 in tax preparation costs, and $2,889 in investment expenses connected to his asset portfolio that he's building for retirement. In total, these expenses combine to equal $9,542 on Jake's Schedule A. Okay, now if you remember in pre-act law, everything from 2017 earlier, these totals are going to need to be larger than the standard deduction in order to allow that taxpayer to itemize. And so for this particular situation, the single standard deduction value of $6,350 for tax year 2017 is very greatly exceeded by this amount, and therefore he is able to use that instead of the standard deduction to calculate his taxable income. So he has only one source of income, and he doesn't have any adjustments, any above-the-line deductions against it, which means that Jake's AGI is equal to the line 7 wages figure of $48,357. After accounting for his itemization total and his one personal exemption, which, if you remember, 2017 is $4,050. He has a total of $13,592 in deductions against his AGI to arrive at a taxable income of $34,765. Now, his marginal tax rate, the income that he's at, it puts him just under the threshold for the 25% bracket, which means that he is currently sitting at the 15% bracket, and his actual tax is calculated at $4,750 because he's paying 10% of his income as tax up to the original threshold of $9,325, and then 15% of the remainder that's left over. He has no additional taxes, he has no non-refundable credits, and he has no additional payments made outside of his normal federal withholding. And the net result of this is a federal refund of $944, which for a biweekly filer would mean that he would be capable of, basically keeping an extra $35 or so per paycheck if he wanted to rework his withholdings for that 2017 tax year. Now, for tax year 2018, there are going to be a couple of very minor changes. We're going to have W-2 wages of $49,518. It's a modest cost of living adjustment, modest COLA amount, slightly larger than inflation. So not too significantly different, shouldn't be too much bigger of a tax burden if we were to have been under pre-act law, because it's a very small amount. He's going to have federal withholding of 5,521. State withholding of 1,628, and local income tax withholding of $956. The elective deferrals and the premium totals are going to go up to $1,981 and premiums of $4,327. In addition, he's going to have the same costs for traveling. He's got to go to the same place. So $496 for the flight costs, travel costs of $614, and mileage for a little bit less, but 2,354 miles. And the meal and incidental rate remains the same for the GSA rates for Oconus travel to Austin. So he's going to keep the same original $148 value. Now, the reimbursements for the meals and incidental expenses for Jake were halted, but the employer does still give him some reimbursements, and so he's giving him 40 cents per mile on mileage to reimburse Jake's localized travel expenses. And the mortgage value is also mostly unchanged. The interest value drops a little bit down to $1,500 due to him paying off more of that principal balance and having a little bit less interest. And the property tax, on the other hand, increases to $1,789. He's got $394 in tax prep fees and a slight increase to his investment expenses to rise up to $2,997. Now, here is where we start figuring out what is going to actually happen. The passage of the Tax Cuts and Jobs Act, or the TCJA, or I'll just usually call it the Act for this presentation, has some significant changes to the IRC that are going to impact his return substantially for next year's return and into the future. The one that's going to be the real big, the kicker on this is going to be the disallowance of 2% miscellaneous itemized deductions. So that's going to mean no work expenses, no investment expenses, no tax prep costs. As well, the act from the suspension period that goes from tax year 2018 through tax year 2025, so January 1st, 2018 to December 31st, 2025, is going to temporarily lower personal exemption values to $0 per exemption. So while they still exist in the code, they will be decreased to a $0 value. So we're looking at no exemption value, and we are looking at no work expenses, no investment expense, and no tax prep costs. Some of the changes are not going to impact him. The aggregate limits for the state and local tax deduction, TCJA introduced a $10,000 aggregate limit for the total in state and local taxes paid on a return, and changes to the mortgage deductibility decreased the amount of the basis, if you will, for deductibility on mortgages from $1 million down to $750,000, which would only be a concern if your client's mortgages, for instance, were larger than the $750,000 figure and not grandfathered into using the old rates. But he has a very small mortgage, so that's not going to have a significant impact on him. So getting into the actual meat of the return, that $0 exemption value for that suspension period is going to change. It's going to go to zero. However, the TCJA does include significant increases to the standard deduction rate. So he basically gets $6,350 from the original standard deduction, and that gets bumped up to $12,000 for tax year 2018 onward. I'm assuming this is also going to be indexed to inflation. Now, the combination of the standard deduction and the original amount for the exemption that Jake had in the 2017 tax law together would be only $10,400. So this actually gives him a slight increase of $1,600 in terms of what amount of income cannot be taxed. But because he lost the 2% miscellaneous itemized deductions, and then they would have totaled about $4,000 after the 2% of AGI limitation. The remaining $5,873 in the legitimate deductions that he has from state and local taxes, mortgage interest, real estate taxes paid will not exceed that $12,000 value, and therefore Jake no longer itemizes for this particular tax year. So without any additional income, and there's no extra known adjustments to his particular income, Jake's AGI of $49,518 is going to be reduced only by the standard deduction value, which leaves a taxable income of $37,518. Now that he's still under the breakpoint for the third bracket, and in the second bracket, which historically pre-act would have been 15%, it's now been reduced to 12% through changes in the TCJA. That gives him a tax of $4,312, which is actually a savings. So he has less deductions, and he has slightly larger income and a larger taxable income overall, but because of the 3% drop from 15 down to 12 in the second bracket for a single filer, this is going to give him a savings of $438 just over the initial tax calculation from last year. Now, considering that the remainder of his situation is unchanged, the difference between the withholding amounts and the difference between the tax liability gives him a refund of $1,209. Now, the TCJA is going to definitely significantly impact his ability to itemize. And I guess the takeaway from this is he's going to have a larger taxable income, but the lessened rate is probably going to be more beneficial, because even though he still, has $36,000, $37,000, almost $40,000 in taxable income, he's still generally considered to be in the lower income because he's below the median wage, generally speaking. But this lessened rate is going to offset the loss of those deductible items and the increase in his taxable income by about $400 in his benefit in regards to his refund. Now, it is important to keep in mind for strategizing purposes that if he continues to pay out of pocket for work expenses, he will continue to obtain no benefit in a tax sense from it. So he should pay close attention, if at all possible, to his employee expenses, so that way they don't negate any of his salary increases. You could even argue that in this particular scenario, that the halting of the reimbursement for the meal and travel expenses was because of their loss of deductibility. Could have been a shrewd business owner for his parent company. However you want to interpret it, the idea is going to be that if you have an employee, common law employee, the 2% of AGI miscellaneous deductions are not going to be able to be taken during the suspension period. So any amounts that he pays out of pocket are just essentially lost to him. Other than obvious opportunities for career advancement or actually accomplishing his job in a strict tax-related sense, there will be nothing that will be gained by spending money out of pocket while working as an employee during the suspension period, pending further legislative review. So even though he does have a little bit of a refund, the current change actually has the non-tax impact of almost wiping out his cost of living adjustment, because the amount of money he's got to spend out of pocket, generally speaking, especially if they in the future get rid of the mileage reimbursement for his local miles, could possibly completely offset any benefits from an increase in his wages from year to year. So it's just something to keep in mind if you do have anybody who does rely on deductibility for those 2% adjustments, that they're not going to have the benefit for it. So your unreimbursed employee-related business expenses and his investment expenses, it might be possible, especially if you are, in addition to being a tax preparer, also offering financial services advice, possibly looking into maybe changing his investments, changing his assets, or going with a different company to try and reduce, for instance, some of those expenses connected to that asset portfolio. 2% AGI, miscellaneous itemized deductions, not deductible at all anymore, so they are not going to count against that taxable income. So lessened rate helps him out. starts getting into a higher income rate or where the change is less pronounced, it's a pretty big change proportionally, and with the impact from 15 to 12% at a lower level of income and less significant for the drops once you get into the higher levels of income, at least on a strict bracket interpretation. All right, for our next scenario, we have Ron and Tammy. Now, Ron and Tammy are both workers. In other words, we're talking about common law employees. So no self-employment, no partnerships, nothing of that nature. We're talking about regular 2 forms W-2 during the year type of workers, and they are going to be filing a joint return together. Now, Ron and Tammy have a fairly large family. 2 of these children are college students. Going to college, they are paying for the expenses for these students and are therefore claiming them as qualifying children on their return. 3 of the children are under 17 years old, one of which has an ITIN number or an individual taxpayer ID number, which is typically given to undocumented workers or people who are not lawfully present in the United States for IRS tax reporting purposes. Now, collectively, Ron and Tammy make $81,507 in gross income and salary in the forms W-2 during the year. And out of this, they have withheld $3,250 during the year in federal withholding. In this particular example, I am placing these individuals in Texas, so they do not have state and local income tax deductions. They could perhaps have a general sales tax deduction or calculate a sales tax deduction off of the tax tables under the supplementary appendices for the Schedule A instructions, but they only have the $3,250. The idea being is that they're not really going to itemize. In the case of this family as well, these 2 oldest children, being both college students, they are considered qualifying children on the return. That's the good qualification for dependents. Ron and Tammy are going to take the American Opportunity Credit, which I'll often just abbreviate or call AOTC, for these kids during the year. It's Form 8863, and it's essentially going to give you a combination 60%, 40% refundable, non-refundable versus refundable credit for education expenses up to $4,000. Now, the other children are also qualifying children, and due to them being under 17, they also qualify for the child tax credit. The youngest child is a nephew, and has an ITIN number in lieu of a Social Security number. Now, this would be more of a concern for pre-act law if we were dealing with the earned income credit, but their combined income combined AGI of $81,507 actually excludes them from being able to claim the EITC under the AGI limitation, so it's not really as big of a deal. And child tax credit under pre-tax law doesn't make any sort of exceptions or special treatment for ITINs instead of socials. Now, both Ron and Tammy also contribute into their own IRAs outside of work. They both contribute the maximum that they can for the year. So it's $5,500 for Ron and $6,500 for Tammy, since she's going to be over 55 in this particular instance and has the additional $1,000 catch-up. And they will continue to do so from now on into the future until they cannot or they become ineligible to do so. And so these 2 things together form an adjustment equal to $12,000, and those are going to reduce the AGI down to a total of $69,507. And they don't itemize, so instead they're going to take the standard deduction. Okay, a standard deduction for a married couple in 2017 is $12,700, and they're going to take the exemption amounts for all 5 of the dependent children on the return, which are $4,050 apiece under pre-act law, and that is going to come to a combined total of $41,000 or $41,050 against their AGI. Now, it is, as a side note as well, it's important to keep in mind that Ron's health insurance plan is obtained through work. It's reported on his W-2. They pay the premiums almost entirely. He's got a very small amount that he pays out of pocket, equaling $1,626 per year. And Ron and Tammy also pay $7,622 in mortgage interest and $2,667 in real estate taxes on their principal residence, but without any significant medical expenses taxes, no state taxes, etc. They don't have to itemize, and they haven't had to do so in some time. Now, they're very close to the threshold, but they're just not enough to get them to cross that threshold. After you take these deductions out of their AGI, you come to a combined taxable income of $28,457. It puts them in the 15% bracket for a married couple filing in 2017, and it comes with a total price tag on that ordinary income tax value of $3,339. Now, the American Opportunity Credit claims for those two college students are based on a combined total of $6,754 in eligible expenses, and it's split $4,000 for the second oldest and $2,754 for the eldest, and that gives them a total of $2,813 in non-refundable credits, and those are going to reduce the tax liability from $3,339 down to $526. And the child tax credit itself is going to take care of the remainder liability and reduces that down from $526 to $0. Now, they don't have any other additional taxes to calculate in the other section, or the other taxes section. So there's no early disbursement penalty. There's no individual shared responsibility payment or penalty for failure to, maintain health coverage, none of that. And these payments that they have against their $0 tax value are going to include their original $3,250 in the federal tax withholding, $2,474 in the additional or refundable child tax credit, and $1,876 in the refundable American Opportunity Credit, and that brings their total refund for tax year 2017 to $7,600. So realistically, in 2017, they could have not withheld anything at all off of their paychecks, had a little over $80,000, and still wound up getting a refund. Now, for the 2018 tax season, there's going to be also, like the prior scenario, some changes, some increases. For one, their combined W-2 wages are actually going to rise by a significant amount, up to $93,896. They're not really too worried about that increase because of the very realistic probability that the reduction in rates is still going to be beneficial for them. So, and they also like that big refund, so they're going to go ahead and increase their federal withholding, and they wind up during the year accumulating $4,250, or essentially increasing their own share of the withholding during the year by $500 a person. Now, this is something that might not make sense if you're looking at it from a purely tax planning strategy. The ideal return would be $0, the appropriate amount of withholdings to match your tax liability with zero left over and a $0 refund. But the reality of the situation is that a lot of families like to have that gigantic windfall check, regardless of whether or not it'd be more beneficial for them to withhold less during the year and therefore take more home. With that being said, there are some other expense changes. $3,414 for the education expenses for the oldest child, and this will be his last year being able to claim the American Opportunity Credit. And then the second oldest child is still maxed at $4,000, and they're going to still be claiming them in the same way that they have done in prior years. For the purposes of this as well, I want to point out that none of the children age out of the child tax credit or for the AOTC in 2018 tax year. So the oldest children are still eligible for AOTC, and the youngest children are still eligible for CTC. Try to keep the scenario as close to identical as possible from a year-to-year comparison. And as a side note as well, the I-10 for that fifth dependent has been renewed for the year and is still considered a valid I-10, but they do not have a social security number yet. They are still in possession of an I-10 number. Now, Ron had another change that was pretty significant, and that's the change in his self-share portion of his health insurance. So the amount of money he was paying out of pocket before was originally a little over $1,600, and that's increased because of changes at his employment level in terms of what they would consider paying out of pocket for his health care. And so he's expecting, or would have expected, an annual total of $6,641, or about $553.45 per month. So as a consequence, he canceled the insurance plan effective July 1st because it was too expensive, and he didn't have to worry about it anymore because they repealed Obamacare Medicare, ACA, whatever you want to call it. He had out-of-pocket medical expenses for, towards his deductible during the year of 2,133, and the mortgage interest and taxes were $7,532 and $2,877 respectively, and their IRA contributions, as I already mentioned, remained the same. All right, now we're going to talk about implications from the TCJA and how it's going to affect their return specifically. So one of the very first things I want to point out is that Ron and Tammy are going to lose all of their exemptions for the year. And since the value is $0 through the suspension period, 2018 through 2025, that means they're going to have a loss of $28,350 in deductions against their taxable income. Now, their standard deduction, of course, is going to increase. It was originally $12,700 for 2017. It is going to increase substantially to $24,000 in 2018, which will offset the loss of almost 3 of those exemptions, so it's not going to be quite as bad. But we are talking about a household that had 7 total exemptions valued at $4,050 apiece that now have $0 for that figure. Now, those 2 things together combined increase the amount of taxable income as a net adjustment, comparing AGI to taxable income from year to year by $17,050 in the positive, because we have a higher standard deduction, but at a loss of all of the exemptions. Okay, so combined with their increase in wages and the negative $12,000 adjustment in their IRA contributions, the taxable income is going to be $57,896 from an original AGI of $81,896. Remember, that's the $93,000 figure minus $12,000, and then minus their standard deduction value with no exemptions and no itemization. Now, that's an increase in their taxable income of $29,439 over the prior year. If their wages had remained the same, it would have instead been a net adjustment, like I mentioned before, of $17,050. They got a little bit more wages, so it's more of a substantial increase, but it is still pointing out that had they kept the exact same wages, post-act would have had a larger taxable income due to the loss of those exemptions regardless. Now, even though the medical expense deduction threshold is at the reduced 7.5% of AGI figure for 2018, it will go to 10% of AGI threshold for 2019 onwards, but it is still kept at the reduced 7.5% for 2018 and earlier years. Even after factoring that in, taking their combined total medical expenses and comparing it to 7.5% of their AGI, they don't have enough medical expenses, even from the amount of premiums for that half that he paid during the year for the first 6 months, and for the out-of-pocket medical expense and so on. It's just not enough to include any of it, and therefore, as a consequence, what we are looking at is that their mortgage interest, real estate taxes, etc., are not significant enough for them to combine and exceed the value of that standard deduction, and so they will still be at the standard deduction value for tax year 2018. Now, with their new taxable income figure, their ordinary income tax liability is $6,567. Even with a rate decrease, we're still looking at an increase of $3,228 over the prior year. Now, the non-refundable education credits have a slightly higher cost basis for one of the dependents. It went up to $34.14, as you remember, so that does mean that there are some changes. So the non-refundable education credits slightly increased to $29.12. Otherwise, there are no other changes to the AOTC from the Act that have occurred that's going to change the calculation for this particular return or tax year. Now, those education credits against the $65-67 figure for the tax liability are going to reduce it down to $3,655. However, this is where some of the offset in the positive for the clients is going to happen as a consequence from the Act, and that is going to be the new calculation for the child tax credit. The child tax credit for calculation for 2018 onward is a little bit different. So instead of it being a base $1,000 per qualifying dependent under the age of 17, it's instead increased to a non-refundable base amount of $2,000 per qualifying child. And there is a refundable component that is equal if they have any excess, for instance. And in case this is all news to you, the non-refundable portion hits first, and the remainder amounts from that total potential maximum figure get calculated as additional child tax credit. The refundable component is equal to $1,400 for tax year 2018 and is going to be indexed to inflation up to the amount of the non-refundable figure in the future during this period. But one of the changes that implemented that is going to count against them in this particular regard is going to be that dependents need to have Social Security numbers in order to qualify. And since only 2 of the under 17 dependents have socials, then their base child tax credit amount is going to be $4,000 as a potential. Now, the I-10 holding child instead is going to qualify for the credit for other dependents, also kind of known colloquially as the family tax credit, at $500. And this is essentially going to be for most of your dependents who do not qualify for CTC or the Earned Income Credit, EIC, EITC, whatever you want to call it. They will have the possibility of having a non-refundable $500 figure for your I-10 holding children, elderly dependents who've aged out of both of the prior categories but are otherwise still considered, qualifying relatives, and so on. So what we're looking at is a potential basis combined between child tax credit and the credit for other dependents at $4,500 to count against that remaining tax liability of $3,655. So the non-refundable portion, that $4,500 potential maximum base, they eat the rest of the liability, for lack of a better word. And what that does is that leaves $845 of the child tax credit available for possible future inclusion from ACTC, additional child tax credit. Now, the family mistakenly believes that the penalty for having no health insurance is eradicated. This is something that I ran across quite a bit during this particular tax season, providing support to our sub-offices across the country, is that a lot of people believed repealing Obamacare, and that's what happened. Nobody needs health insurance anymore, and so they canceled their plans. Unfortunately, the individual shared responsibility payment, or the ISRP, is still in effect for tax year 2018. It is definitely repealed from 2019 onwards, not suspended, but just flat out repealed. But in their particular scenario, the required annual payment amount that it would have cost for them to purchase this health care at $6,641 is less than their affordability threshold. The required contribution threshold historically in 2017 was 8.16% of household income. It's been reduced to 8.05% of household income for tax year 2018, and 8.05% of their household income would be about $629.89 per month before their insurance would be considered unaffordable. So on the basis of that alone, the taxpayers, unfortunately, are eligible to take the ISRP on their return. Now, that ISRP is going to be either based on the flat amount or 2.5% of their household income after you run through the calculations that come in the appendices of the Form 8965 instructions. I used 2017 figures, and it came to a penalty for half of the year for the family equal to $1,043. And that's because the relevant figures for tax year 2018 haven't been released. Taking a look at some of the other guidelines, other documents that are floating around out there, the Kaiser Family Foundation, for instance, is what I was looking at. There is definitely premium increases, baseline figures being about 17% nationally, which does mean penalty calculations should be higher for 2018, but none of the actual figures are published yet because they take the national average cost for a single plan and for a family plan and use that as the maximum possible penalty for the percent of household income calculation. In their particular instance, it's just safer to go ahead and assume a $1,043 figure for sake of this comparative example, but in reality, this number could be higher. And as well, just assuming, for instance, that maybe he didn't have health care, offered to him through his employer, neither did his wife, the 2018 poverty guidelines from the Department of Health and Human Services put this family just underneath the 250% of the federal poverty line. If you've done exemption calculations on 8965 in the past, we're trying to figure out penalty amounts or whether or not coverage is considered affordable, families who are under 250% and not otherwise exempt because of a lack of Medicare expansion or some other reason, generally speaking, could get legally affordable coverage through the healthcare marketplace or its state-based equivalent. So even if, it wasn't him who canceled it, but his boss who canceled it, they probably still could have gotten healthcare through the marketplace. And therefore, there's really no ameliorative effect on the return for trying to apply for an exemption, with the exception of the ITIN holder, who would be exempt historically under a Code C on that 8965 Part 3 for basically not being required to have healthcare coverage because they're not a United States citizen and not lawfully present. And the effect of this ISRP is that it's going to increase the other taxes calculation to $1,043. Now, they have $4,250 in federal withholding, and those $4,250 eliminate the ISRP calculation, leaving $3,207 for the payment section of their refund. And in addition to that, they're also going to have just a slightly higher refundable American Opportunity Credit amount because of the increase in those qualified post-secondary education expenses, which is going to give them $1,942 to add on to that prior $3,207 figure. And for the additional child tax credit, in case you were curious, how that's actually calculated is on a Schedule 8812, and what that is at a maximum of 15% of their earned income over $2,500. So you take their earned income, multiply it by 15% after you subtract their $3,000 under pre-act law or $2,500 in the taxpayer's benefit for 2018 onward, and that remainder child tax credit figure of $845 is nowhere near those limits, so they're going to get the whole $845 on top. So combining AOTC, combine the ACTC, so education credits, additional child tax credit, throw that on with what's left over from the withholding, and even after that shared responsibility payment, they wind up getting a refund for tax year 2018 of $5,994, which is a drop from last year to be certain, but they did also have increases in their wages. So, I mean, it's not too significant of an impact, even though they are getting a little over $1,500 less on their refund comparing 2018 to 2017. All right, so for the takeaway, Ron and Tammy, the biggest impact is obviously the loss of all those personal exemptions. I mean, we're talking about increases to their, increases to their tax liability that pretty much would, in most other cases, wipe out any benefit from having that large family. But, we're looking at these personal exemptions gone. The increase in the CTC amount definitely offsets both the ISRP calculation for failing to maintain, which they won't have to worry about from 2019 onwards, and the loss of CTC in the full value for the ITIN holding dependent. But the bigger consideration is to think about what happens as these children age out, because there's no exemption value, so the value of these children or these dependents is really going to be equal to the maximum credits they have. So as they age out of child tax credit, as they age out of the American Opportunity Credit or don't qualify, whatever their prior year values were are an increase to their taxable liability that they will need to consider. For the purposes of the example, even though I haven't explicitly mentioned it, for instance, in 2019, one of the children would age out of CTC and would go from $2,000 down to a non-refundable $500, and one of the children would age out of the American Opportunity Credit, cutting off a maximum possible inclusion of $2,500 in their, in $1,500 to $1,000 60/40 split. So you're looking at a combined total of almost $4,500 of potential credits that they could have gotten, but the dependents aged out on that would have to be split up into their withholdings during the year. Even if their income remains static, those credit values themselves are pretty significant. So, they're looking at probably needing to consider at least starting to hold $90 to $100 extra paycheck in federal withholding, assuming that they're on a biweekly schedule across both of their W-2s apiece. So, it's something to keep in mind when you see people that are approaching that age out threshold. If they're still able to claim the dependents because of gross income, residency, relationship tests, and so on, then they're still possibly capable of getting the credit for other dependents, which is $500 non-refundable. But that is a far cry from a $2,000 potential maximum for CTC, a $2,500 potential maximum under AOTC, and any possible amounts for the earned income credit were they to be lower income. So you do have individuals who are going to start losing their dependents to filing their own returns, to aging out, to not qualifying, etc. It might be worthwhile to have them take a look and reconsider the amount of withholding during the year, make sure that they're not going to get any nasty surprises when the next tax season rolls around. All right, now next we have Devon, and Devon is a very high-earning single taxpayer based out of New York City who is employed during the year by two large firms. He spends a significant portion of his day trading for a lot of his income, and that's reported to him with like massive packages of paperwork from various investment groups and so on. If you've ever seen combined statements from any of your regulated investment trusts and so on, they're usually pretty big. He also recently purchased, and I mean recently in the context of it being before the December 15th, 2017 date for the cutoff for the change in acquisition indebtedness, a $1.6 million apartment, which he has a mortgage face value of $1,270,000. He has no children, he's not married, and just continuously invests his profits into other assets. Collectively, he earns $330,000 from his W-2s, and out of that, he withholds $81,106 in federal and $24,107 in state and local tax withholdings. He's also earned $157,751 in net short-term capital gains and $266,700 in long-term capital gains during the year. Makes $18,500 in elective deferrals to his 401k and outside contributions to a traditional IRA of $5,500 during the year. Now, his Form 1098 shows a total of $23,287 in real estate taxes paid and $56,756 in mortgage interest paid during the year. Now, there is a $1 million acquisition indebtedness limit and a $1,270,000 loan value, so apportioning them out to roughly 78.7% of the costs, we have a total deductible value of $18,336 and $44,690 for tax and interest, respectively. He also pays $29,544 in deductible investment expenses during the year for managing this portfolio and $895 in tax preparation for tax year 2017. Due to the PEAS limitations, he can only itemize $128,194 of his allowable $142,983 for 2017. He's also over the threshold for the personal exemption phase out, and he just essentially loses the value of that exemption. And his high wages, significant AGI, and the high amount of investment income on the return give him a total of $17,466 in the additional Medicare surtax on his wages, the 0.9%, and the 3.8% net investment income tax, or the NIIT. He pays quarterly estimated taxes of $27,500 to the feds and $13,500 to the state, respectively. Combining all this together, his AGI is $754,451. He is therefore over the threshold for any of the adjustments to income that might possibly matter in this regard, and instead he takes the gross total of his capital gains and his earnings together. His $128,194 itemization reduces taxable income down to $626,257. This puts him in the 33% bracket. And I've got a little star there because looking at that total, you would think that he would be over the threshold and in the pre-act 39.6% bracket, but he's actually in the 33% bracket because of the long-term capital gains going through the Schedule D tax worksheet. With his long-term capital gains rate of 20%, on the eligible long-term capital gain income, it's going to give him a combined total of $152,450 in tax liability. And his income is also high enough, and the tax value on his Schedule A high enough to trigger 6251, so he has AMT value of $18,248 to add back, giving him a total tax burden in this case of $170,698. There's no non-refundable credits, but he does have those other taxes that I mentioned before, the NIIT, the additional Medicare surtax adding back in for the total tax value running down the page of page 2 of the 1040 of $188,164. Combination of his withholding from wages and estimated quarterly payments together is 191,106, and the net of these figures generates a very modest refund of 2,942, which Devon is going to put towards his estimated totals for next year. For tax year 2018, we're going to try to keep this somewhat simple. The calculations get a little bit harder to do once you start getting into all kinds of different types of higher level income, especially considering a lot of the forms are still in draft or haven't been released yet. So for 2018, Devon's employment contracts are basically going to have him keep the same wage values. No increase, and he's not going to change withheld taxes just for simplicity's sake, and he's going to instead modulate his estimated payments to make up for any of the attendant difference. Capital gains transactions are going to be a little bit higher. So for 2018, we have short-term capital gains of 175,223, long-term capital gains of 314,298. The state and local tax deduction for the income taxes paid to New York are collectively going to come to $29,226 for the year, and the state estimated payments will come together for $56,750. The elective deferrals and the IRA contributions are going to remain at the tax year 2017 levels of $18,500 and $5,500. Investment expenses are going to go up to $32,991. Mortgage interest and real estate taxes are going to have a pre-apportioned amount of $55,714 and $24,102 respectively. The total of the estimated federal payments made, including the refund from 2017 applied forward, is going to equal $129,642, and other than that, no differences exist. This also means, by the way, that the $895 in tax prep fees is still technically present and factored into this as well. So, talking about the changes to the TCJA, one of the first things going to happen is we are going to be dealing with some significant differences on itemization. So the SALT limit, the state and local tax deduction limit of $10,000, is going to get rid of $75,976 worth of the deductions from his Schedule A. But that reduction in tax, however, spares him from the AMT. So he's going to pay tax on almost $76,000 more in income, but he is not going to have an additional $18,248 roughly in AMT that was present on the 2017 return. And the removal of the 2% AGI miscellaneous deductions, unfortunately, as well, is going to move all of his investment expenses, as well as getting rid of the deductible tax preparation costs. So essentially a non-adjusted total of $33,000, $34,000 is not going to factor in here. The changes to the acquisition indebtedness limit from the $1 million down to the $750,000 limit are not going to affect him because he has a mortgage that is going to, that was signed into before December 15th of 2017. And so this allows him, after apportioning to the roughly 78.7%, to take $43,869 in interest and $18,978 in real estate taxes off of those earlier values. The removal of the P's limitations would restore his personal exemptions, except for the fact that there's $0 in value during the period from tax year 2018 through 2025. The P's limits being removed, however, does mean that the itemization totals are not lessened, so he's going to have a total of $72,847 in deductions against his AGI of $819,521, which is going to leave a taxable income of $746,674. Since there are significant long-term capital gains, the tax bracket 35%, once again, because of the capital gains not in the highest, because those get factored, those get taken off, is only going to count towards the ordinary income tax item, and instead he's going to have a long-term capital gains rate of the 20% after the exemption of $38,600 for a single filer on the $314,298 in long-term capital gains for $62,860, which is going to stack with the ordinary tax calculation of $127,021. Combined, the tax liability starts at $189,881. Additional Medicare surtax is unchanged because wages are not different, but the NIIT increases from gains increase up to $18,602. Combining these together, we're talking about a total tax liability of $209,820. Against the combined total of the withholding and the estimated payments of $208,048, he's going to owe the IRS $1,772. Overall, this is within 1% of the prior year liability. So the act is significantly beneficial to him. I mean, he went up enough in income to change his marginal bracket from the third to last to the second to last. And despite all of this, his overall tax burden only increased, if I believe I ran the calculations when I was doing this over here, about 0.6%. So it's fairly close to where it was before. And the takeaway from this is that your better rates and your better AMT calculations and a larger AMT exemption are going to somewhat offset the loss of significant portions of itemized totals, and the elimination of the P's limitations help keep the totals higher, except for the personal exemption phase out, which doesn't matter because of the $0 value in the first place. Now, this situation would be a little bit different had he lived in a place without high state and local tax values. Tax situation would have likely been far more beneficial. The impact of the legislation for individuals who would maybe take sales tax, for instance, or would never have to have worried about it before for the state and local tax deductions and comparing pre and post act, it would have been far more beneficial in their cases. So it's going to be kind of hard to figure it out until you start putting numbers in and until we start getting forms as they come out towards the end of the year. And I guess what the overall takeaway is that this legislation, despite what you may think about it politically, is going to have better rates and larger refunds for a lot of your clients, generally speaking. The taxpayers who itemize may be hit hard and inconsistently by the TCJA. So if you got your itemization totals, you got clients that come in and itemize, you might have people who are impacted significantly different from one return to the other and have really no way to predict it until you've done a few of them and kind of see how the winds are blowing with the situation in your area and with your clientele. Families with large numbers of dependents may be equally burdened with increases if they don't have access to the more generous credit calculations, and ITIN holders will generally increase liability comparing pre to post act. I have already seen and know from individuals in the industry that the market for doing returns for ITIN holders has somewhat dried up or dropped off from its pre-current administration values. People are not filing returns. I'd imagine this is probably going to accelerate the process. But just one thing to keep in mind, especially with these dependents, is to pay attention to those credit limitations, the possibility of them aging out. Make sure that the clients are aware that the loss of the exemptions is not going to be benefited by credits that they can't get. So they might need to adjust their withholdings. All right, at this point, normally, a live presentation would be a question panel on the side. Otherwise, feel free to use contact submission forms or email webinar at Federal Direct Tax in order to give us any questions, comments, concerns, corrections to the material. Otherwise, you can also contact us Monday through Friday during non-tax season hours from 9 a.m. to 6 p.m. Eastern Daylight Time at 866-357-2052. Thanks.